Thanks for tuning into Talking Point today. I'm your host, Neeraj Shah. Our guest today will talk at length about how he sees the earnings picture unraveling over the course of the next few quarters. As difficult as it may be, it makes sense to try and second guess or try and lay a hypothesis about what earnings would be because it's on the basis of this hypothesis that one might be able to make a judgment or take a call about what the indices could do, because over the long term, no matter what happens, market revert back to multiples and earnings. That aside, of course, we'll talk about a few other pain points and other pressure points as well with Aditya Narain from Edelweiss. He needs no introduction, really. He joins us right now on Talking Point today. Aditya, good having you. Thanks much for taking the time out. Hope
You
all
for
is safe.
having me on your show.
The pleasure is ours, Aditya. Aditya, so just a broad brush question before we dwell full tilt into the two or three things that we kind of discussed that we talk about. A lot of uh, diverge, diverse opinions come to me from eminent people about whether this market should be valued on a price to earnings multiple, or a price to book multiple, or a market cap to GDP multiple, or averages of all the three, take historical valuations into account or no. How would you go about doing this exercise?
See, I tell you, given that the market has seen a valuation that was 30% lower than where we are today, just a couple of months back, I think we should step back from trying to be very rigid with the methodology, right? Because there is no right methodology, given that you've seen such humongous swings over such a short period of time, right? The way I would look at it is that we have to look at growth beyond a supply disrupted year. So the current year is a supply disrupted year, right? But we have to look at earnings from a next year perspective and really take a call on one, is that a normalized year? And my sense is you have to take that as a normalized year. But I think what's also very important is that you have to take it as a new normalized year, right? Because this is going to be not an extension of FY20 showing 2 years growth and getting into FY22, but it's really going to be an FY22 earnings level that potentially could be very different from an FY20 level, right? And so in my view, I think the big focus should really be on two things. What is a normalized level for the economy and for earnings, right? And within it, what is the composition going to be, right? And I think to some extent you will end up falling back on a PE, but you have to look at it in an FY22 context, and you have to look at where the earnings are coming from. And I think that is what is going to be most relevant rather than an absolute number, right? See, I think at least in my view, valuation sometimes is as they say, time ki baat hai. Someone was saying it's very cheap 3 months ago. Someone was saying it's too expensive because earnings are going to run off. Right. So I don't think it's sacrosanct, right? But I think what does tend to be a benchmark that you can rely on is a certain normalization, right? And that normalization is about level and it is about mix. And I think that's what you need to wait for or play for.
Can you explain that a bit? I mean, and kind of extrapolate your point a bit. I mean, when you stop, what do you mean by when you're saying new normalized? Is it essentially the fact that the themes or the sectors which will lead to these earnings would be materially different? And again, just a small follow up, Aditya, out there. Now we've seen that there are two big disconnects, right? Disconnect between the economic, how the economy is doing versus what earnings are doing, and a disconnect between what the Nifty 50 earnings might be showing versus what maybe the Nifty 200 earnings might be showing. And frankly, a lot of people now have a larger portion of the non-Nifty stocks in their portfolio as well.
Right. Right. So I think a lot of it is going to be, see, I'll tell you, what I would say has happened so far is that everyone has looked at it from a supply perspective. The enthusiasm that you've seen in the market has really come from the fact that you're talking about capacity utilizations going up, that there's no visibility on products, more stuff is available, right? It's been a supply phenomenon. I think and that supply has really been a function of an administrative diktat. If you shut down stuff, you will not have supply. Once the restrictions are removed, the supply will come. I think the issue switches to really what happens with demand, right? What is the structure of demand? What is the shape of demand? Because within these 3 months period and the next 3 months that's going to follow, there is going to be a material disruption and a material dislocation in incomes, in job profiles, right? And I think that will change. That is going to play a very important role in terms of how demand shapes up, right? So again, so what that really means is that in FY22, you're going to have a demand mix that is different. One is the level, as I said, I think that level will potentially be a little lower, not just not just in terms of the incomes that are earned, but also the propensity to spend, right? So that will potentially put your income level lower, right? But within it, what are the shifts that tend to happen? Firstly, in terms of the consumption bit, right? And the second bit is in terms of how the market values that is going to be a function of what you see as something that has structurally moved up and what you see as something that has structurally moved down, right? So the very interesting ones, there are some obvious ones that are work from home and IT and stuff like that. But the very interesting one, I think, is auto, right? Auto, right? There has been a big focus on there's going to be a cyclical bounce back, which, part of it you are seeing, right? But the issue is, how do you debate the structural bit? Are people fundamentally going to travel less? Okay. And so the demand for all these guys is going to moderate? Or are people going to look for personal mobility rather than public mobility? Right? Which is also an argument. And those are the areas where you will have the maximum amount of interest, right? And the maximum amount of dichotomy, how people are prepared to value those opportunities, right? It's like the electric car. The reality is, people have made the call that if cars are to stay, right, it is the electric car, and that's why that's one of the reasons why you're seeing Tesla move, right, the way it is moving, right? But I don't think there is enough of a call, right, in terms of whether people are going to prefer, whether people will, just not travel enough, so they will not need these vehicles, or that people will travel and they want to travel by themselves, right, and rather than in public transport, which means there's going to be a structural uptick. And so far, whatever's happened with the demand, right, or the easing of supply doesn't give you any real sense. So FY22 is going to be a year where you've got to make those calls on whether, right, whatever be the earnings, what is the longer term outlook for that? So for instance, our call on IT is a very strong one, that this is a business paradigm that has changed from a demand perspective, and from a supply perspective also it becomes cheaper for these companies. So you have a very favorable mix. And we can keep debating the pace of this happening, but you're really going to have an expansion of this. I think autos lies fundamentally somewhere in between, right? And that's where you have to make a more intrinsic call, right? And the third bit is what you would call what have been the so-called fragile industries, which have got really badly battered, airlines, hotels and stuff, right? You will also come to a point there. Is this something that's going to move up, or actually the back of these businesses has been broken and it's going to come down, right? So I think FY22 will be very, very interesting, right, in terms of level. And I would not necessarily say level of earnings. I would actually focus on level of revenue. Okay, and I'll tell you why I'm saying that, right? I'll talk more about top line because that is a better reflection of demand. And as I said, it'll be a question of top line and in terms of what is the structural bearing on this, right? So I think those two factors will be very, very material, right, in determining what that PE is, right, and which are the sectors that get that PE. After all, the PE is one large aggregate, right? So that's one bit, and I'll come back to your earlier question, right? So I think that's one bit. I think the second thing that one needs to look at, and this is the interesting thing, and this is where there is an argument for support to the market's move, right? Which is, you might have an issue with top lines, but theoretically, bottom lines might actually, for the companies which are on the right side, bottom lines might do much better because the extent of cost squeezing that can be done, right, both in the new way of doing business, but also in that COVID has been an opportunity for people to look at their costs ruthlessly, which they have not done, right? So you could have a situation where top lines come down, but bottom lines go up, right? And I think this is going to be a landmark thing. If you ask me what is going to be defining with COVID, right, it is going to be the fact that Indian businesses are going to take a knife to their costs, right? Whether they need to or they don't need to, right? There's a difference, right? There are guys who need to because they're struggling, but for others, it's going to be an excuse that I've not looked at my costs for so long. not looked at them hard enough. This is my opportunity to look at them hard enough, right? And I think that's where a lot of the confusion as far as the market is concerned, and I wouldn't call it confusion, is like, I don't know. But those are the differences in terms of outlooks that the market is tending to grapple with. I might add, if I just extend this, I might add, if you actually go back to the GFC, right? Everyone talks about the collapse and XYZ, but really, and all the monetary support that came through. But the very interesting thing there was that once it was all over, right, by 2010, from 2010 to about 2014, US businesses continued to expand their margins. There was no job creation, there was no real top line, but they continued to expand their margins and their profitability because they relooked at costs, right? India didn't do it because the fall was very short and it was just an early stage of growth. I think this time India has been a mature or an overripe kind of economy and business sector from a cost perspective. I think costs are going to go out a lot, and that is going to be a positive for corporate sector profitability for the guys who are leading that charge, right? Again, its impact on demand, cost, somebody pays for it, or somebody's income goes if a company reduces costs. I think its impact on demand can be more sizable than is being anticipated at this point in time. But from a profitability perspective, you just might have a larger pool.
Okay. So there will be two kinds of companies, right, Aditya? You mentioned that revenue growth would be the more important factor. And then there are companies who, coupled with this revenue growth, will also be able to reduce costs and thus, on a growing revenue base, grow their profits even more. Do you think the markets naturally will reward them disproportionately, maybe with multiples which are higher than historical averages, because the number of the companies that will be able to do both would be precious little?
Yeah, see, okay, let me rephrase it. I'm not necessarily confident that they will be able to grow their top lines. Okay, because as I said, there might be issues with demand, right? X of commodity prices and all that, right? But I'm quite confident that they will be able to bring their costs down and so their bottom lines down, right?
Okay.
In which case, profitability will do very well. The thing that you mentioned, top lines and bottom line, that potentially, in my view, lies only with the IT space.
Yeah.
Okay. Right. In the IT space, you could have that, right? And so you're already seeing valuations move off, and I think that could go on a lot longer. I think for the rest of the ecosystem, which is more domestic, right, where there isn't such a structural change in demand, but even if you get more or less the same demand back, you will have the support of costs, which will give you that profitability. So I think IT is a space where you could see a seismic shift in terms of how they are being valued. As I said, you've seen part of that, but it's not just a response to some events. It's something that might be sustainable a little bit beyond.
Okay. Now, before I get to the bigger conversation again, can I do a follow-up since we are on this topic? And because I have had conversations with one of your peers, ex-peers, Vikas, he was on the show and he was talking about this IT and he echoed what you just said. And then I had one more, peer of yours, if you will, Nilesh of Envision, who tracks IT for a really long time. And both of them had conflicting views. And I would want you to tell me what argument do you think is more weighty. One is the same thing that you said, that margins might actually move up because companies will be able to control costs, and in IT's case, revenues might move up too. And therefore, would that lead to valuation bump ups from what they are right now as well? Conversely, Nilesh had this one interesting point to make, that currently, in the current scheme of things for the next 2-3 years, maybe, IT companies, if they start chasing margin expansion, they might have to let go of revenue upticks because some other companies will come and take that pie. And therefore, for now, margin expansion may not necessarily happen. And if margins don't expand, valuations don't move up.
So I would look at it a little differently, right? Rather than the pure competitive dynamics at the company level, right? I'll give you one example that was there. I read about this in one of the newspapers about a month or two ago. It basically said SEBI is looking to get the IT chaps in a company, or the guys who facilitate board meetings, right? Since all of it is happening, work from home, right? SEBI is planning to get those guys as insiders or people who will be restricted for the reason that suddenly they have a lot of access to, they're privy to a lot of information that they should not have. And in the event that they have it, they should be restricted. Now, this is a very light kind of example, but I think it has a lot of meaning, because what it tells you is that the role of the so-called IT guy, right, from being one, who supports the bulk of the team below, is now he's literally sitting on the board, and there are a bunch of guys who are being restricted because they are, they're such they know so much, right? Now, to me, again, this is a soft way of looking at it, but this is a function of how much IT as a role has been elevated and the level it has gone to. And this is IT services. Technology was always on the board. This is IT services. So that's one bit, right? A light way of looking at it, but it tells you a sense of the elevation, right? The second bit is, and we've just done a report, and the title that I had in mind, we didn't go with it, was IT goes tech. Okay. Right, which is that IT goes tech. IT goes tech.
Interesting.
Okay, right, because you have the technology companies and you have the technology world. IT is still seen as technology services, right?
Yeah.
By saying IT goes tech, it is telling you in terms of, one, that it is going to, ride the coattails of tech in some senses. B, you can't have tech without the services that support it. So the league and level have shifted up, right, in terms of where these businesses are going to be valued, right? And the third thing I'll say is just go back decadally in some senses. In 2000, technology was considered the biggest. It's still called the dot-com bubble, right? Now you just step back and say, was it a bubble or not? Yes, it was a bubble because it came down. But weren't the greatest companies of our times created then, right? There might have been 1,000 and 100 survived, but it changed the way we did business and it changed the world, right? So it's not one of those flower bubbles that goes and you're just growing some more tulips, was it, I think, right? It's not that. You created the greatest company in the world, right? 2008, 2009 was to some extent similar, right? You had this bust up, but things shifted towards efficiency. And I think this one and the one that you're seeing now, COVID, in some senses will be defined by WFH, right? It has suddenly changed the way people live, the way people work, and the importance and influence of technology, right? And in that context, I think when you see these seismic shifts, then we can debate about margin and we can debate about pace of growth. But when shifts are seismic, right, the framework tends to change, right? And I think that is what you are seeing for the broader technology space, right? But IT services is not like a Y2K event, but it is something that is going to ride the coattails of this whole technology thing, right? So there's been in WFH, what is the one new thing that has come up? The only new product that has come up is Zoom, which has come to the forefront, right? And maybe Teams, right? But the amount of work that the IT guys have done would be all IT services. One is product, and it's a product that existed, by the way. It wasn't as if it was a new product. None of these were created for this. These were existing products that got a new lease of life. Everything else around them has really been support, right? And what this package that you sent us, these are all developments that we wouldn't have heard of before, right? So I think it is seismic in that context, and I think that's how you need to view them. Rather than necessarily margin goes up, somebody will come in and get in, right? I think those dynamics will be there. Individual companies, you will have to potentially play from that perspective. But I think it has changed the landscape, right? And I would tend to view it in that context rather than anything else. You could have always argued Google was too expensive in 2011, 2012. People could have said the same thing about Facebook, right? The reality is it's not a fuzzy need out there. You use Teams, you use Zoom, these are things that everyone is using. And the reality is, a lot of people think of it as, it's a US phenomenon. Technology as it exists today is a global phenomenon. These are not local market phenomena, right? When Zoom gets valued up the way it does, right? It is because you're talking about the whole entire world's market and all the support that comes around it, right? Comes from whether it is the IT services companies here or in Israel, it's the same bunch of guys who are doing it. So I think that paradigm change is what I would tend to look at rather than the nitty gritty. Yeah, if it moves up a lot and then there are issues about margins and all that, it's fine. But what you've seen with some of the results that have come out for the IT companies, right? The results that they've been not as soft as what people expected, but that's completely backward looking. I think it's the guidance, it's some of the commentary that is coming through, which is entirely different, and which is what you got to keep your eyes on.
Viewers, and just my summation of this is, don't try to think of it as an extension of the past in IT services. The future may be just completely different, and they are integral spokes in the wheels of all that's happening. Yeah, very well put, Aditya. Thanks for that. Okay, so now getting back to the bigger question, right? And then we'll move on from earnings to other factors as well. We've got about 20 minutes, maybe we have about 10 more. But just one quick follow-up there. Would you believe that in the run-up to FY22 end or FY23, when we might have more normalized earnings, if I can use that term, spaces which seem to be on course for some predictability of earnings, because the business model is such, telecom, back-end manufacturing, specialty chemicals, etc. They are all priced very, very well. Do you reckon that the market may actually price them more simply because they seem to be more predictable than autos, than hotels, than other forms of discretionary?
Sorry, I missed the point you said. Which bit would be valued more predictably?
I'm asking that the spaces which look like being able to deliver more predictable earnings, do you think the markets will value them more because they are predictable, whereas the others are not?
See, I'd put it two ways, right? One is, I think at a base level, yes, which has been the case to some extent. I think that might get a little exaggerated, right? But, cyclical valuations start coming through, right? When you're looking at distinct cycles coming up, right? And I don't know what cycle we will be looking into FY23 and 24 in FY22. Okay. But if it is, again, if the argument is that the economy, reverts to some normalization, but doesn't have another kicker, then you will end up having these very structural and stable earning stories tending to get that premium. If you have a situation where the next year and a half is fundamentally weak, which means even cyclically it is weak, then you might end up with a situation that there might be higher valuation that are attributed to it, because you would be closer to a cyclical rally than otherwise, right? So it's hard at this point to say how the market will be in FY22, but that will be a function really on the cyclical outlook rather than a remnant of what has happened in the recent past, right? It will not be a function of FY20 or 21. It will be a function of where FY20, 21 and early 22 has culminated. So the cyclicality will be greater, quite honestly, if it's much lower, right? Rather than if you continue to get this run, then I think then you will end up saying cyclicals is where you should be actually underweight, because you've got a bit of a cycle that's come through.
Okay, fair call. The other point that we wanted to discuss, Aditya, and that is the need for capital raising. And it's more pronounced in financials right now because they are the ones going out and raising capital, in addition to Geo, of course. Geo is a separate case in point altogether. But it's very, very pronounced currently in financials. And the government has shown its hand or intent of wanting to divest in certain assets where it can as well, because BPCL is the flavor of the season right now as well. What's your sense of, one, the nature of companies who are raising the capital? Are they better placed because they are able to do that? And two, the pressures that this may put on the secondary market as well, because we know that the domestic flows are kind of going through a rough patch. And if indeed this supply of capital comes in and takes away the institutional capital too, what does it do to the secondary markets?
So let me put it this way. I think the capital raising will be highly cyclical, in the sense, if the going is good generally for the market, the ability to raise capital will be very, very high. Okay. For the reason, and I'll tell you why, that your domestic flows and your traditional foreign flows, right, at this point in time are dwarfed by the huge amount of liquidity that has been generated in the global system. And that is going to sustain for a period of time. No one's going to pull it back in a hurry, right? So if there is a sense that the economy is going in the right direction, right, which is either in terms of structurally settling down well or cyclically showing some tailwinds, then I don't think you should look at the dynamics of the local money market, right, or the availability of flows in the local market, right? Because then there is enough liquidity sitting out there to be tempted to come through, right? If on the other hand, the market is not doing well, or there is a sense that structurally things have got more challenging, or that cyclically the recovery has got pushed out much further, right? In which case, that money will not be interested, and then you have to worry about the money that you're playing with, right? In which case, it will end up being very, very narrow, right? So again, I'm not giving you a call, but my sense is a lot really depends in terms of how it plays out, right? I think where you can be relatively comfortable is that for quality stuff or stuff that's showing a revival, there is appetite. You've seen that, the ease with which some of the better players have been able to raise money. But that doesn't answer the question on whether the next level will be able to raise money or not. That next level raising, quite honestly, is a function of how we do over the next 6 to 12 months. If things seem to be getting... My sense is, I think money will be around. I don't think money is going to disappear. I think I don't think you will have people paying money for stressed businesses and distressed stuff, right? I think it is still going to be people who will pay money for India over the next 3, 4, 5 years, and that is not pay necessarily for valuations, but pay for growth. Okay, and so I think it will, unless there's a big reversal on the upside, it's going to be more quality focused. It's trickle down will tend to be a little slower, right? That's how I would typically tend to see in a normal environment.
Okay. Can I ask you, Aditya, what's the typical conversation between Aditya and some of the largest money bags that you guys cater to? I mean, are they wanting to invest into, let's say, India financials? Because I was listening to a Howard Marks moderated event with OPT fellows only, and they were saying that in India, the bigger headline is not COVID-19. 2 months ago, of course, that India, the bigger headline is not COVID-19, but the shadow banking crisis, and therefore financials are a problem. Are people willing to put money to financials, part one? And are people willing to put money into the other areas as well, which you are telling them? And what is it that you are telling them in the first place?
So I think a lot has changed over the last month or so, right? I think at that point in time, there was no appetite for financials. I think that has changed. You've seen it in the capital raising that's done. You've seen it in some of the capital raises that are being lined up. So my view is, again, people are not wanting to pay you for getting out of a crisis. Okay, I don't think there is the appetite for that, right? But if people think you are past that, I think there is effectively a willingness to pay up, right? I think for the next level, as we just had the discussion, it won't be so easy coming. It will be a function of the markets. Right. But there again, I think it will tend to be where you give growth visibility rather than plugging a hole where there will be quite honestly appetite for. Plus, of course, you will have some of these structural things. People will pay for IT. People will pay for pharmaceuticals. These are places where they will effectively pay for. And I think FDI, you will see people wanting to buy up assets, right? But those will typically not be from the market perspective. Those will tend to be more in the form of businesses, right?
Got it.
Again, but I'll tell you one thing on this. Capital raising is a very cyclical affair. When the time is good, you get a lot of money for a lot of things you wouldn't expect for. And when the time is bad, you don't get money for anything, right? So it's a little bit of a chicken and egg story. The cushion, though, is you're so early in the pump priming cycle globally, right, that there is money out there. And if there is any excuse, whether it's market performance, whether it's stronger recovery, right, whether it is a particular opportunity, or whether, like you've seen, a tech opportunity where someone thinks, I'm going to give you an internet opportunity in India, people will pay for that.
And how? Yeah, make hay while the sun shines. Actually, just can we end this conversation with a view on that, Aditya? it was considered to be a uniform telecom story between two and a half or three people. Suddenly, the table has changed. It almost seems as if one player is now decided that I'm going to uh, play poker on a different table with completely different players. You guys continue
Right.
playing the game that you were, and which is not a bad game, by the way, because there's a bit of a not a
Yeah.
monopoly, but a duopoly or something like that out there in India too. So, do you think the players at the second table will still have the game going for them, or is it past, and or is it even possible to decipher that?
No, I don't think it's past. At the end of the day, the underlying revenue is still coming really from the pure telecom business, right? Which is getting a massive leg up, whether it is work from home or just the way we consume data, right? So there has been that seismic shift, right? So I would believe the platform value would clearly lie there. I don't think that will suddenly get hugely discounted unless there is a capex cycle that people are pushed into, right? That can change the dynamics.
Hmm.
But
Hmm.
X of that, I think that value will tend to lie. I think beyond that, I think it's a question of then how you position, right? Whether people want competing stakes, because one of the things that's also happening is that India is really the last open market for any large global player to put its stamp on, right? And so, how others think about their presence in India will actually also be a key determinant in terms of how this tends to play out, right? But yes, at this point in time, the needle has swung a certain amount, and you're not getting a competitive fight back from the other side because they're saying, we are going to play our own game because we play what we understand. So I think the good thing is it's good to be in a country where people are competing for footprint, right? Um, you would want it to be more broad based because what that tends to do is then it just widens the whole space. It's more competitive. It is better for the customer. But we have to see how that plays out, right? You've had successes everywhere. You've had successes in the e-commerce space. You've had successes in the education space. There are opportunities in the health space. Is that a great space generally in India and globally? I think it is. I mean, the fact that Nasdaq is where it is just tells
Yeah.
you, and it's corroborated by the way we live and the way our dependence has moved on to these things and the way our dependence has shifted so extremely in the very recent past.
Yeah, that's true.
Right.
Well, you know, I wanted to talk about four or five things, but we discussed two things and still we've gone on with it. So this was lovely, Aditya, but this only points towards us doing more interactions in the near future. So look forward to have you once again very soon on Talking Point. But thank you for
Thank you
today.
so much. Thanks so much. Yeah, thanks.
It
Bye.
was a pleasure talking to you. And viewers, thanks for tuning in to this conversation of the Talking Point.